On October 6, 1979, the Federal Reserve altered the mechanics of global economics through a technical change in how it controlled the supply of money. Double-digit inflation was rapidly eroding the purchasing power of the dollar. These 99.9-cent gas prices represent the physical reality of a macroeconomic crisis. Previous central bank regimes had consistently buckled under political pressure. Fearing unemployment, they kept real interest rates negative, bailing out the economy to prevent a recession. The decision to end this accommodation happened quietly inside a bureaucratic boardroom, but it ensured economic disruption that would reach every household in America. Volcker's intervention served as a calculated decision to stop protecting the economy from pain. To protect the integrity of the dollar, the central bank was forced to choose between the long-term stability of the currency and the immediate output of the American economy. Under the old regime, the Fed explicitly targeted the federal funds rate. To keep that interest rate artificially smooth and politically acceptable, officials had to constantly adjust the total supply of money. During the Saturday night special meeting, the committee officially abandoned interest rate smoothing to directly target the raw money supply. The new metric was non-borrowed reserves. The Federal Reserve would strictly control the quantity of money, letting the market dictate the interest rate, the price of borrowing it. Without artificial smoothing, interest rates rose to historical highs, eventually peaking above 20%. This technical accounting shift provided Volcker with a political shield. He could claim the Fed was merely controlling the money supply, while the market did the brutal work of hiking rates to unprecedented extremes. High interest rates alone cannot stop inflation if the public believes the central bank will lower them at the first sign of a recession. Economists Marvin Goodfriend and Robert King argue that roughly half of Volcker's disinflation was achieved simply by re-anchoring public expectations about the future. The committee understood they were plunging the country into a severe recession, but viewed it as a necessary cost to prove the Fed was no longer politically constrained. Volcker demanded that the Federal Reserve's actions be perceived by the public as overwhelmingly strong. He stated, "I certainly conclude from all of this that we can't walk away today without a program that is strong in fact and perceived as strong." The domestic cost was incredibly high. U.S. unemployment climbed to 10.8%, reaching its highest level since the Great Depression. This pain manifested physically. American agriculture movement farmers drove tractors into Washington as the political backlash focused squarely on the Federal Reserve. The interest rate itself did not cure inflation. The visible, prolonged suffering of the American public is what finally convinced financial markets that the Fed was dead serious. While the domestic pain was intentional, a massive shockwave spread across the developing world. Throughout the 1970s, developing nations, heavily concentrated in Latin America, had gorged on cheap debt funded by excess eurodollar liquidity. The architectural flaw in this structure was that these loans were overwhelmingly contracted using floating interest rates tied directly to the U.S. dollar. As Volcker's policies pushed the U.S. federal funds rate near 20%, the interest obligations on Latin American sovereign debt exploded. At the exact same time, global commodity prices crashed. This destroyed Latin America's primary source of revenue precisely when their debt payments peaked. Volcker's decision to save the dollar inadvertently weaponized the global financial architecture against the developing world. Both the Great Depression of the 1930s and the Volcker Shock triggered a sudden stop in external financing to Latin America. Data shows that despite having a more advanced financial system in the 1980s, the economic contraction in Latin America was actually far worse than in the 1930s. During the Great Depression, Latin American nations simply defaulted on their debt, clearing the deck and allowing them to implement domestic recovery policies. In the 1980s, default was not an option. Latin American debt grew to equal 180% of the capital of 9 major U.S. banks. The United States and international institutions aggressively forced Latin America to avoid default, implementing austerity measures to ensure Wall Street banks remained solvent. Latin America was forced into a lost decade of development, effectively sacrificing their own citizens' welfare to prevent a collapse of the U.S. commercial banking sector. By the fall of 1982, the Fed began a reversal. Volcker did not permanently transition the U.S. to strict money supply targeting. The operation faced an instability in money demand, and the Fed was consistently missing its own monetary growth targets. With inflation finally falling to 3.8% and the economy hurting, the Fed quietly abandoned the non-borrowed reserves experiment and returned to targeting the federal funds rate. The reserves target was always a pragmatic weapon. Once the psychological war on inflation was won, the severe tool was discarded. The Volcker Shock overthrew the politically compliant policy rules of the 1970s. It established the modern mandate of central bank independence, the requirement that monetary policy be insulated from political election cycles and immediate public pressure. Today's standard practice of preemptive rate hikes to maintain a 2% inflation target is the direct descendant of Volcker's credibility war. The Volcker Shock was a deliberate transfer of pain, from inflation to unemployment, and from U.S. domestic policy to Latin American collapse. In 1979, the Fed decided that to save money, it first had to make money painful.